I think Bitcoin and Ethereum held up really well because like in prior episodes of liquidation events that you could have seen Bitcoin and Ethereum fall 30-40%, but instead they barely fell. But in that market, there is a bit of leverage because crypto does attract people who like to use leverage, and there's volatility, but that combination can be quite lethal when liquidity shrinks. And so it was kind of a negative, adverse combination of factors.
Tom Lee begins with a moment that shook the crypto world. On October 10th, a headline about Trump and China trade relations triggered a chain reaction, a cascade that led to the largest single-day liquidation in crypto history, bigger than the collapses during COVID, bigger than the chaos after FTX. Billions were wiped out in hours. But the real story wasn't the price drop. It was the plumbing of crypto that got exposed.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Well, on October 10th, there was a headline, related to Trump and China trade relations that caused a pretty big drop in crypto prices. And that triggered a cascade of events that led to the biggest liquidation, single-day liquidation in the history of crypto. So it was bigger than FTX, bigger than COVID. And I think it exposed that there were some problems within the plumbing of crypto, and those ripple effects are still happening today. There's a lot of people who are kind of trying to put the events together, but you're right. Bitcoin and Ethereum actually proved to be pretty resilient. I think they only fell roughly peak to trough 7% during that liquidation. A lot of the smaller cryptos fell 80% or more. But what they ended up tracing this to is there was a feature in some of these exchanges called ADL, automatic liquidations. And when the collateral that someone puts to borrow money, if the price of that drops, it triggers an automatic sale. So some of the small stable coins actually went below $1 momentarily. So what you thought was safe collateral because it was worth $1 suddenly fell 40%, then that triggered a cascade of liquidations. That is what spread sort of really quickly across the network.
Is that a macro, micro kind of combination thing all happening at once? Because it begs the question, do this, I guess it's the wrong word to say small cap coins, but as crypto has multiple tokens, does that signal maybe a consolidation? Does that signal maybe a rethinking of what should be even in the system?
I think as people look back, I think Bitcoin and Ethereum held up really well because like in prior episodes of liquidation events that you could have seen Bitcoin and Ethereum fall 30-40%, but instead they barely fell. But in that market, there is a bit of leverage because crypto does attract people who like to use leverage, and there's volatility, but that combination can be quite lethal when liquidity shrinks. Yeah. And so it was kind of a negative, adverse combination of factors.
Perfect storm, as they say. I want to get your thoughts on Ethereum. Obviously, your fund staking, you're all in on Ethereum. Bitcoin, we all know, is a store of value. Ethereum's a productive asset. Talk about that aspect, because there's financial opportunities in thinking of it that way. Explain again why you think the Ethereum staking is so important, because if you're getting yield, you can organize around that.
Yeah, I mean, I think foremost, Ethereum is a smart contract blockchain. So you can essentially program a lot of information and store it. That allows you to do a lot of things that are really useful. And it's in contrast to Bitcoin, which really is essentially stored energy, or digital gold. Yeah. One of the big breakouts this year in terms of product adoption has been stablecoins, which is a dollar that's tokenized onto the blockchain. And a tokenized dollar or stablecoin is useful because you can use fractional payments. Instead of something being in pennies, a stablecoin drops to 12 digits. So it's good for micropayments. And there's a lot of finality, right? You can send money, send dollars, and you know that these transactions are final. Well, it turns out Wall Street's interested in tokenizing more than just dollars. There's a lot of talk about tokenizing, as Larry Fink would say, tokenize everything onto the blockchain. So equities, bonds, credit, real estate, what they call real-world assets. You'll need a neutral blockchain to actually essentially create these products and run it on. Ethereum makes a lot of sense because it's got a vast network of validators, meaning there's a lot of security. It's also been around the longest. You know, it's celebrating 10 years.
Yeah.
And it has had 100% uptime, which means it's very reliable. And the Ethereum Foundation, you know, has been pushing forward ideas and projects and in a way that is trying to be Wall Street friendly. And I think that's also really important. You know, in fact, the fact that they're hosting an event here at the NYSE makes all the difference in the world. The NYSE is the most prestigious exchange in the world, right? Everybody in any country who does markets knows what the NYSE is. For everything that happens in the real world, like economic activity, there's one unit of financial transaction. So the NYSE sits really at the center of that. You know, everything that happens in the world has to essentially go through an exchange, and you know, NYSE is again the most prestigious exchange. More things are moving to digital. You know, I think more than 50% of all economic growth over the past 10 years has been native digital, and it's just a matter of time that as money has become digital, like, you know, and you're tokenizing digital dollars, that it means that what becomes traded on a digital exchange isn't just stocks anymore, and it's not just bonds, and it's not even just real estate. It may be prediction markets. You know, that's become a huge breakout.
Polymarket investment, $2 billion by NY.
Yeah, and Polymarket has really been good signal for markets. You know, Polymarket correctly predicted in the 2024 election, 50 out of 50 states. You know, the prediction markets got those correct. And in the New York City mayoral election, correctly called Mondami as the winner. So the prediction markets are proving to be really good signal for markets, but also that's taking events and making it a financial product.
Yeah, I mean, it converts everything to data. All right, if you look at the market today, okay, and I asked you, okay, in your world, okay, when you're staking and you're running this now crypto native thinking and systems that you're building and management of it, when I say what's a headwind and what's a tailwind, how would you answer that question? What's a headwind and what's a tailwind for you?
Well, yeah. Well, I mean, I'd say the headwind for crypto continues to be that it is a very competitive marketplace. And so there's a lot of ideas, and, you know, the best ideas win. So it's important for people to navigate that carefully. Because there's a lot of DeFi projects out there and a lot of good ideas, but, you know, only a handful are going to really break out. On the tailwind side, of course, is that we know that there is enormous efforts and interest in moving everything digitally onto the blockchain. So that's going to be a 10-year tailwind for the industry.
Yeah.
Tom Lee identifies both headwinds and tailwinds. Headwind, competition. The space is crowded. There are thousands of projects, but only a few will survive and scale. For investors, that means discernment is everything. The best ideas win. Tailwind, a massive decade-long structural shift, the migration of everything of value to the blockchain. Think about it. Global GDP is around $90 trillion. Global financial assets exceed $300 trillion. If even a small fraction of that moves on-chain, we're talking about trillions of dollars of tokenized assets, all relying on base layers like Ethereum and Bitcoin. That's not just growth. That's exponential network value creation.
I mean, I think in, you know, Ethereum's network value today's, you know, maybe 400 billion or so. But global GDP is 90 trillion, okay? The total size of global financial markets is, you know, 200 trillion. Maybe more.
Yeah.
It might even be 300 trillion. How much of that ends up on blockchains? The idea, according to Larry Fink, is to move 100% of this onto the blockchain. So we're talking trillions of dollars of assets moving onto layer 1 blockchains, that creates a lot of network value for the underlying chain that's essentially the base layer. So yeah, it's...
Yeah, you mentioned Larry Fink multiple times, and also Secretary Besant. They're all pro this direction.
Yeah. So we could see, exponential upside.
So there's two parts of NFTs. One is the art side of NFTs. And the other side is, what does non-fungible smart contracts enable? The art side is the leading side. It's showing what happens is, in a digital world, we ascribe digital things as now having value. Before blockchain, you can create infinite amounts of digital things. With blockchain, you can create scarcity. So digital things now have value. That's a huge breakthrough. We did that with money. You create a scarce money, it now has more value. That's Bitcoin. And with art, we've done the same thing. Digital art had zero value, and now suddenly it has immense value. And we've seen artists experimenting with NFT technology, what they can do, how they can get it to transform, and we've seen that store of value has lasted. And we've battle tested the technology at scale via a massive NFT speculation boom last time around. But NFTs are so much bigger. Humanity is organized by a system of contracts. For you and I to turn up to this interview today, it was an email. But it's a contract. Hey, you'll do this and I'll do that. Every time you go into a shop, every relationship you have is basically a contract, including your marriage or whatever. Everything is a contract. An NFT is just a contract. It's a contract for a piece of digital art that is stored on chain, that you own it. It can be the contract for a house, title deeds of your car. More importantly, your own ID, or every ticket that exists. We will definitely use NFTs more than anybody has a comprehension of, and it will be the largest part of these crypto networks. And brands tried it to create loyalty and networks around brands. And many of them walked away because they don't have the long-term mindset and how to do it. And it's not easy. Everyone's experimenting. It was early. But let's say you're a company that has tickets. Let's call you Eventbrite. You've got 90 million users have no connection with each other. You can't give value back to the network. You can't create an easy loyalty system. You can't have people building on your network because it's not a network. It's a SaaS model of, hey, I just use your website and I can invite a bunch of people to a party or an event. Now, if you tokenize that, each one of those events becomes an NFT. We can see who's got what in their wallet. We can see, hey, Mark likes art events and music, and he also likes to go to these kind of bars. And before I know it, I've got a social profile of you, so I can deliver things of value to you. Or you can then connect, let's say you hold an event in New York City, everybody has an NFT, you know who they are, you're doing something different, or you've got a partner that wants to access that same group where there may be value, you can use the NFTs. If you think of the music industry, you can now do a lot with an NFT to permission people like you're a super fan. Hey, you've done this, you've gone to 5 concerts in a row, we're going to give you a special NFT. That NFT gives you right to early stage access to new music or front row seats. Well, now that has value. And you can either cash in the value yourself by using it, or you can sell it to somebody else. So you've spent 10 years being a Taylor Swift fan, your NFT might be worth $25,000, $30,000 because you've been a super fan, but now you're kind of grown up and you don't like Taylor Swift anymore. You could sell it to somebody else and they get those rights. So you create super brand loyalty. You create a much better cohesion layer of social graphs on the internet. So brands don't realize it yet, but this is where everything will go. And it surprised me how slow it's been, but it will happen at scale.
Lee touches on one of the most misunderstood sectors, NFTs. Yes, the art boom was speculative, but it proved something revolutionary. For the first time, digital objects can be scarce. Before blockchain, anything digital could be copied infinitely. With NFTs, we can assign unique ownership to a digital thing, and that changes everything. Art was just the beginning. In truth, everything in human society is organized around contracts. Every agreement, transaction, or identity. NFTs are simply digital contracts stored on-chain. In the future, NFTs won't just represent art, they'll represent property titles, identity documents, vehicle registrations, tickets, loyalty programs, and even brand relationships.